Okay, welcome to the Airme Roundtable. Today we're going to talk about butterflies and iron condors. We're doing a workshop. Today's the 5th of July, my parents' anniversary, but they're no longer with us, but I always remember it. So um, for normal disclosure, Airme is not a broker-dealer, investment advisor. Options, futures, bonds, and currencies of all risks are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole thing, pause the recording and go to the bottom of any of our web pages. Attribution, you will possibly see screenshots from Thinkorswim, TradingView, maybe OptionNet Explorer. And so big thanks to everybody on here and others that help us do what we do to make it easier. We are recording. I did hit the record button. And oh, that's nice. This is okay. So the overview is wrong. Disregard that. So now let's talk about some popular option trading strategies. So we have butterflies and condors. I learned how to do animations, learned looking at Scott's slides. So
very nice.
Butterflies and condors, they're very similar. They're both a combination of two vertical spreads, and you can construct them as all calls, all puts, or calls and puts, which is an iron butterfly or condor. And they can be constructed as directional or non-directional. And you can have symmetric butterflies, which usually are a lot cheaper, or asymmetric butterflies. And it's usually if you want to take a directional opinion like the M3 or A14, or even the road trip was similar to that. And so there's a question, are symmetric butterflies neutral, bearish, or bullish? What do you guys think? Why don't you guys type in the chat here? Oh, and I'll make it so everyone can see all the answers. Neutral, bearish, neutral. Yeah, Larry's got it. Depends on where you place them. So if we go back to this slide, if the market is here, then it's neutral, right? Because the T+0 line is very flat. If you place it and the market's over here, well, now you've got some positive delta. So that's, and you need the market to move up to make money on this. And on the other hand, if the market's over here, you need it to move down here. So this would be a bear setup. So that'd be a little negative delta. So the symmetric butterflies can be either one, neutral or directional. Some people like Ernie at 0-DTE, he'll put a butterfly on pretty far away. Let's see, where's my mouse? There it is. He'll put it on maybe, can't see it now. Okay, there it is. The market might be here and they expect to move somewhere over here. And then these are very cheap and he's looking for a really big reward to risk ratio here. So and then Dan Sheridan used to call those like time bomb butterflies. So you're paying very little to take a cheap shot at a pretty nice payoff over here. And then the asymmetric ones, again, can also be bullish, bearish, or neutral. It depends on where you place them. Like, I think, Amy, the A14, you're putting those closer to here, which is kind of like John Locke's M3. And at that point, the delta is very flat. So it's fairly neutral. And if the market just stays here, that line will increase and you'll make your money. If you put it up here, like the road trip used to be, you kind of want it, and we would usually start the road trips with slightly above zero, so lock in a little bit of a profit. That would be neutral to maybe slightly bearish. You wouldn't mind it going down, but you wouldn't want it to go down a whole bunch because that's where all the risk is. And again, if you put it over here, then you want your positive delta, so you want the market to go up. So yes, they can be any direction you want, neutral, bearish, or bullish. Just where you place them. So the butterflies, we'll talk about them first. They have a lot of variables, time to expiration. So like Eric today in our 0-DTE did 2 butterflies, and the first one I think he said took 14 or 4 minutes, and then he had his profit. So you can trade these on very short time frames, like in minutes. A lot of people do 0-DTE, zero days to expiration. Other butterflies like the A14 is 7 to 14 days normally. And then the M3 type of trade was, I think, 30 or so days, if I remember correctly. And the road trip, we were doing them out to 90 days. So they can be as short or as long as you want on the time to expiration. And the distance between the strikes, you can make them really wide or really narrow, and that'll affect the price and the reward to risk ratio. The deltas of the closest strike. So if you have like a road trip, we were putting those, I think, about 1 standard deviation out of the money, maybe a little farther, and then others maybe in the money. So where you place it and how much delta you have, and that'll some of the variables that you can control. As we saw, directional or non-directional, and long or short. So almost everybody in the retail space, when they think of butterflies, they're thinking of buying a butterfly. But Scott Ruble is going to show us in this workshop that he trades a lot of short butterflies, and he'll use them to in different scenarios. Either he'll open it as a short butterfly to start with, or he'll take another trade and convert it into a short butterfly. So for instance, if he has a long call or a long call spread and it's moving against him, he'll sell another call spread against it and create a short butterfly. And like he said, here's like your zero line. Maybe you start out with a spread like this and the market's moving against you. So then you sell another spread against it, and then you end up with, do a different color, then you end up with something like this. Oops, sorry, let me kind of do that better. Something like this, where it's a short butterfly, and it might be for zero or maybe a small credit or debit, but you've basically taken all the risk off the table except for this area here. And it depends on how much time there is to expiration. If you're like a day or 2 or 3 out, the odds of SPX falling within a 10-point range over the next 2 or 3 days is pretty small. And what typically you'll see for these is the T+0 line will be very close to zero like this. And then as time passes, you start falling into the sea of death, and this will start bending more and more as you get closer to expiration. But even on a 0 DTE trade, if you sell one in the market, say right here, when you put it on, this the amount that you've lost, even if it like wanders into the sea of death, might be 10, 20 cents for most of the day. It really won't start opening up until the last hour or two, because there's still a good probability that it's going to move away. This versus a vertical spread, if you have a vertical spread like the red line and the market just collapses this way, you have a lot of risk. But if the market also goes down on a short butterfly like this, you're actually fine. You're actually making money, or at least in this case, break even. So it's a nice trade to know if you've never traded a short butterfly. There's a lot to like about it. And when I was at SMB, what was his name? He runs the phase trader indicators, Jeff Algan. He had a class on short butterflies. So it's not a new concept. Scott did it all the time in the pits. He said even during the day, the trading day, if the prices are moving and it moves through like a 5-point strike, and he can get at least 70 cents for a short butterfly, a lot of times he'll just put one on. So he'll talk about those and managing them. And then as far as symmetric and asymmetric condors, same kind of deal. So here's your condor. And if we have to make this symmetric, where's my little mouse? There it is. It's here. Then the market's centered on your condor. That's pretty neutral and symmetric. And again, you can make them bullish or bearish, but you can also have asymmetric condors. And this is kind of what the weird or was, or the asymmetric iron condor, where you have less risk on one side. And you can play around with these, make them as that where this is above zero, so you have no risk on the upside. So the market goes higher, you don't have to do anything. Typically, like the way we did the road trips, for instance, would be the same where the condor. If you have a little bit of risk on the upside initially, and the market's moving higher, you just either like roll this strike up or take this spread off, or there's different things you can do to lift this side up and bring it above zero to make a profit. And I guess I already answered this. So symmetric condors can be, again, just like butterflies, neutral, bearish, or bullish. Depends on where you place them. And again, condors are very similar to butterflies, so they have the same types of variables: timed expiration, distance between the strikes, so wide or narrow. Obviously, you don't have that with a butterfly because the center strike is the same for both. The deltas of the closest strike, you can vary that. Directional or non-directional, again, you can control if you want to take a position on a bias on a direction or not. And again, long or short. Now, again, people focus mostly on selling condors, but you can also buy them as well. So that's another way to get like a higher reward to risk ratio. We're not going to talk about those in the workshop, but for instance, if you have your zero line here, and a typical condor might be like this. You know how many condor traders, these high prop condors we used to call them? Well, if you flip that upside down, now you've got a reward to risk ratio like this. So you're taking a little bit of risk, and if the market moves either direction, you're going to be pretty happy. You know, maybe you sell this, maybe you pay $1 for this, and you can close it out for $9. You know, a lot of iron condor traders would put these on in the old days, and they'd make money, and then 1 month they'd lose everything they made in the last year because it just blows up, because you have that gamma, and you know, a big price move is really difficult to keep up with a condor. So bottom line, what's the difference? Basically, a condor is a butterfly with the center strike is split. So you have 2 strikes in the center instead of 1. So if you have a butterfly and you move one of the options at the center, now you're creating a condor. And that's like the narrow iron condor that Dan does. It's basically a butterfly, but you just take that center strike and move it 5 points away, and now you've got a condor, but it behaves a lot like a butterfly. And by contrast, if you have a condor and you make those 2 short strikes identical, you've just turned it into a butterfly. So what underlying do we use? We trade SPX. It's outstanding. There's lots of reasons for it. It has daily expiration. So if you're into zero DTE trading, it's fantastic. It's heavily traded, so slippage is really small. The spread prices are in 5-cent increments. It's got great leverage. Commissions are efficient. It settles to cash, so you don't have any assignment risk. And it has the IRS Section 1256, which is that 60/40 favorable tax benefit. And then let's talk a little bit about Dan's favorite strategy, the narrow iron condor. Now, we were just talking about this last hour in the Boxcar Zero DTE meeting, and Dan's been changing it a lot. So this is some of the new stuff, but even this is starting to become outdated, and I did it like yesterday and the day before. So Dan's trading this as a zero DTE trade. And Dan, I know you said for like the first 30 to 90 minutes, but I think today it was even before that. It was like the first 21 minutes. So you're entering this a little bit earlier in the day.
Yes, a little bit, because the premiums are higher. I don't really enter them right at the open. Number one, because I haven't had my coffee yet, and number two, because the wicks of the candles will be, well, the wicks and the body of the candles will be really wide, and so you don't exactly know what is quote a good price. And secondly, within just a few minutes, you really don't know yet what the direction of the market's going to be, and that will naturally affect the premium of the Strangle. So I'm waiting at least for 20 minutes, and then I see if the Strangle is coming down, that is what I want, and then I'll get in the trade.
Right, and we can show that chart too that you're using to monitor, but to put the trade on, the short strikes are normally 5 points above and below the cash price. And then this was from an old slide. It's probably still good. I know right now you're using 30-point wings, but I think if the vol's higher, you're going to spread that out a little bit.
Yeah, if the volatility is higher, I might start with a 10 point, and it would probably be like 40, 10, 10, 40.
Right. And then the minimum size, I think you recommended 2. Your wife Lynn is learning the trade, and I think she's going to start with a 2 lot. But
yeah, Lynn's going to either do a 2 or 3. I'm trying to convince her to do a 3, but that may be a hard sell. I don't know.
Well, and like this this bullet says the more lots you have, the easier it seems to me to adjust it.
Yeah, that's the thing. Yeah.
And then you record your entry prices for each leg, and especially the short option prices you're filled at. And then you're determining the initial theta, and then the profit target is 12%. For example, if you have 2,000 theta, $240 initial profit target. Dan, how'd you come up with the 12%? Was that just experience?
That was just an empirical observation. Basing that on what my profit target used to be before I started this new methodology here. And then on your spreadsheet, I just used basic algebra to reverse engineer what the premium would have to be to get that 12%. But now with my new strategy, following the Strangle price itself, I'm trying to get more than 12%. But for people who would like to do it the old way with more micromanagement, I think 12%, simply based on empirical observations, I think that's a good number.
And then now this is from last week. What we were doing was creating conditional orders to buy a long call, 5 points in the money if SPX hits the short call strike. And the same thing for the puts. If the SPX moves down to the short strike put, you buy a long put, 5 points in the money. Now these were conditional orders, but I think today you said you're not doing that. But like you said as well, that this is more kind of a good way to do it, kind of a safe way.
No, I think this is a good way, particularly for people who are just, pardon me, for people who are just learning the trade. I would definitely recommend having the conditional orders in place and on either side, just as you have listed there.
And the nice thing about this is it fixes your deltas right away and flattens things out. So as the market, if it keeps moving, you're not getting hurt nearly as fast, because those longs really help quite a bit. And we used to be buying them a little bit away from the current price, so the delta wasn't quite as effective. But by buying it in the money, basically at the original center strike, you're getting more than 50 delta. So you're getting quite a bit of delta for that one call or put. And then there's also the possibility, because now you have an extra call or an extra long put, if the market doesn't keep going and starts coming back, you can either close it or sell another call or put against it to either create a spread, or there's lots of ways you can manipulate those single calls and puts. Let's see. So here. Okay, so if SPX is moving more than 5 points beyond your short call or put, consider rolling the bad side. So if your market's moving up, you're getting hurt with the call, so that's the bad side. And then you want to move those options probably 10 or 15 points further away, so you make the market keep moving to catch you. If it's a trend day, you can close all or some of the bad side, and that'll create basically like a short put spread if it's moving up, or short call spread if it's moving down. And you can also consider selling more premium on the good side. So, if the market's moving higher, if you're selling some puts, that'll help fix your delta a little bit and bring in more theta and help your delta out. Any other pieces of advice for this, Dan?
Well, actually, your second bullet point there makes a good case for actually having a conditional order to buy a long, because let's just say, for example, you had a contingent order to buy a long call, and the market is moving up, and then it really becomes aggressive and moves up strongly. Your call is filled, and now you see, oh my goodness, it's really moving up. So you close all your calls, and now you're going to have a T+0 curve with that extra long in place that's going to be pointing up quite a bit. So if the market continues to move up aggressively, now your long call is making some big bucks.
Right. It's like, I remember Dan Sheridan used to say, your best friend in a bear market is a long put. And the same thing on a trend day higher, your best friend is a long call.
Yeah.
Okay, and then this flexible grid, I think it's still available at Thinkorswim. Let me see if I can get that that URL for you. Put it in the chat. And there you go. And Amy also mentioned that she's going to be showing some Russell Index Iron Condors as well. So we're not just trading SPX, but this flexible grid works pretty well. I think I've got one up here. But we were talking about this new thing that you've been doing, Dan. This is the Strangle price for this is the at the money Strangle, I think, for today. And you can see it started out here, and this higher high, lower low indicator is fantastic. It's freely available on Thinkorswim, and you can see if the lows are kind of above this trigger line, is trending lower, and here's kind of congestion. Here's kind of trending lower again. But it's a lot of chop here, but it's a great indicator for price action as well, not necessarily just the price of a Strangle. But you were explaining to us a little bit earlier today about how you're following this chart and using it to guide you with the trade. And maybe you want to take a minute here and talk about it?
Yeah, sure. Well, the chart itself, has the MOBO bands, which you can see there. Those are MOBO modified Bollinger bands, and they're very narrow, and they're color coded. When they're going down, they're going to be magenta on your screen and my screen. And then I also have a moving average. They're the white line, which you have. And then I have ATR dots. And then I have the swing highs. I mean, the swings,
Swing high and swing low.
Yeah, and so the swings are the red dashed lines, and the swing highs are the red dashed. The swing lows are the green dashed. And
there's oops.
Yeah, and so I basically want the direction of everything to be down. I want the swings to be making lower highs, and I want the ATR dots to be falling, and I want the MOBO bands to be falling and preferably magenta. And I like to have the higher high, higher low chart mainly showing the higher high red line. And so monitoring this in addition to the risk graph is what I've been doing recently, placing less emphasis on the overall position delta. Obviously, I look at that, but as long as the Strangle premium is falling, and I don't know, Tom, if you need to show the how you would make that chart, or if you're going to give people this chart, or I'm not sure what you're going to do.
Yeah, I haven't shared it yet because I have to rebuild it. I have to figure out how to get rid of this thing on the right.
Yeah, well, basically, you have to have the opera code. If you look up there on the left, you're basically, adding the two opera codes. And that's what is generating the chart.
So the way you do this, you find the at the money strike, say here, right click, copy that. And you only need one because you can go paste plus paste and then just change one of these P's to C's. And then now that's the call plus the put. And you just paste it in here. And there's your chart.
Yeah.
So pretty fast. And I intend on adding this to the GOAT too. So
okay, good. Yeah. But that's an easy chart to generate. And it gives a tremendous amount of information, because not only do you see the overall direction, but you can also see, as I pointed out in our earlier session here today, the zero DTE session, you can see that the candle bodies, when the market is beginning to move, the candle bodies will get wider and the wicks will be longer. And that's a sign when you may want to, if you don't already have a stop order in place, you might want to get one in place. And right there right there is where I got stopped out on mine today. I was pointing out in the earlier session, my 5 lot was up $1,400, and I got stopped out at $900. So I gave up $500 because it's not, I mean, if it moves quickly, your stop order may not be exactly what you get. After all, it is a stop order. So I gave back some money, but on many days, and perhaps even most days, the strangle just will continue to decline, until the end. And I followed one on Monday. I got stopped out, earlier at around 900, 950, something like that. But I followed it for the rest of the day, and it would have made $2,500. So generally, it just will continue to fall. But you have to have a stop order in place so that, like every other kind of trade, so that you're not badly burned.
And Larry asked the question, is everything on this chart standard toss? Yes and no. I mean, the squeeze indicator is available. This is the Squeeze Pro from Simpler Trading. So this one is you have to buy, but there is a free version on Thinkorswim that I think it's just slightly different. I'm not sure exactly what the differences are, but they're pretty minor.
It's very minor. You don't get the what is it? The yellow dot? Yeah, you don't get the yellow dot, which is sort of an early indicator. But I think on Thinkorswim, if you go under TTM, you'll find it.
Yeah, so TTM.
There
Probably
it is,
the
right
squeeze,
there.
TTM
Yep.
squeeze. Yep.
And that's so that's a freebie, and the higher high, higher low is free.
That's also free. Yeah. I
The
think everything else is free.
Yeah, the swing. Now those are my swings. I sort of customized the swings, but there is a regular swings on Thinkorswim, and you can customize it if you want to. And the same with the ATR dots. You have to set your standard deviation on the ATR dots, and you have to decide in advance, how close that you would like them to track.
Right.
And those are actually the trailing stop dots. So that's also free. It's in Thinkorswim under ATR trailing stop.
So those are some changes essentially. Let's see. I don't know if there's anything else you want to talk about that before we move on, Dan.
I was just going to point out, I guess, I'm not sure that was actually shown on your chart, but on the trailing stop dots, naturally you want them to be red because you want the strangle to be falling. But you can see when on your chart there at 1035 with that big green candle, notice that the trailing stop dot changed color.
Orange.
And yeah, and this is because the candle penetrated the previous red trailing stop dot. So that's a good, that's an easy way to monitor this. And basically, you just want the premium of that strangle to fall the entire session. And if it does, money will be coming into your account.
Well, like you said, that's where you're making your money on this decay.
Yeah.
Okay, so the next thing I'll just talk a little bit about the GOAT. I just named it the Greatest Options Analysis Tool just to have something fun to refer to it as. But I've added some things recently to help with managing these trades. Like one of them is use red. This section right here is new, and this is to help you roll up the or roll down your puts or calls. So you can select either I'm rolling up or down, like here. Oops. And then that'll control if it's up, it'll be this direction. If it's down, it'll be minus, and then it'll subtract or add from these strikes here. So right now it's up, so plus 10, so 44.50 changes that to 44.60. And then the arrows just let you just easily copy. So if I type in a number 10 or say number 15, then I just click the button and it copies it over to this cell. So you don't have to type it in twice. And then the set strikes is after you've gotten fill, and you want to reset these strikes because everything else on here is kind of keying off these. Then you want to click this to set these strikes to whatever you've got in here. And we've also got, you can roll all of them, or like the puts and the calls, or just roll the puts or just roll the calls. So it's pretty flexible, and it tries to estimate what the position delta is going to be based on how many contracts you have and what the new deltas are of the new strikes. So that's going to tell you what the change in delta is going to be. And then we also, I've been working on this. This is kind of a work in progress. This is, again, fairly new, where you type in your initial theta, and then the short strangle premium you've received, and then your target profit, and it'll calculate how much that is in dollars, and then the price of the spread. So if you wanted to put a price in to exit, you could do that with this, and it'll also tell you what the target yield would be on the margin that you're using. So a few new things with this.
Yeah, I also added another line there right under the short strangle premium for the current short strangle premium.
Oh, right, the current price.
And then so that makes it easier, very easy, just to look at the goat and see how you're doing. And if the current is less than what you received when you sold it, you're gravy.
Right. This is one of my favorite tools too, this Delta Fixer. I love this thing. So,
yeah, that is neat.
so it lets you, well, I can just show you live. It lets you choose between a combo, which is basically just a long put, short call, or if you're bullish, a long call, short put. And then you can do a hedged combo, because if you have the combo without the extra long put here, your margin could be a problem. If you already have an extra long put in place and you want to do a bullish combo, but you have the extra put, then you don't have to worry about margin with this. But if you don't have it, then you need to do a hedged combo or a risk reversal, and that'll keep the margin under control. And you can control how far away from these strikes this one is, and same thing with the risk reversal. So this will be 15 wide for both of these, but you can control it. You can say, maybe I'll do a 20 wide, and then how much delta change do I need? And you just click find strikes, and there's a 20 delta adjustment for you. And you just click this and paste it into Thinkorswim, and there's your order. So actually, risk reversal is kind of an interesting trade by itself. This one's for a 15-cent debit. They're generally pretty cheap. So you can take a cheap shot if you think the market might be trending higher or lower. You can put a bullish or bearish risk reversal on fairly inexpensively and take a cheap shot at getting some nice returns if the market moves. The other day I made about $50 on one lot, just guessing the market was going higher, putting a cheap risk reversal on, and it worked out. Other things you can do are vertical debit or credit spreads, or even a single. So it'll find the nearest strike that's like 22 or less in this case.
That's an amazing tool.
Oh, and Amy asks, what's the Delta Fixer working off of? Okay, so I've got this chain tab. So this is loading. If these are the same, it only loads at once because you don't need two. But it's working off this option chain. And you can load some other things in here, like the EMR is the expected move ratio. Think of that as how many standard deviations away you are. So if I'm looking at today's option prices, like this 44.35 put is trading at 75 cents with a 13 delta. And then I've got the theta on here too, but that's a 1.37, 1.39. So that's about 1.4, well, not 1.5 standard deviations away from problems. And you can also pick other fields on here. You can turn that on or off. You can do volume or open interest. Volume is actually pretty interesting. You can see how many contracts are traded. Look at this at the money calls, 55,000 contracts traded today. And then you can put other fields on here like gamma, vega. I don't use it anywhere in the spreadsheet, but I can. So if you wanted to load those, and you could, add your own things using Excel to get it. So I've got all these, all this data available if you want it. But the Delta Fixer is using the data from here And the way it works is I've got this fudge factor. So if I'm looking for, say, oh, I like the hedge combos, and then we're looking for a target delta of 20, and it's always a positive number. It's not negative. If you try and put a negative number in, it'll give you an error message now. So we're looking, say I want a 20 delta. I need markets moving down. I need some positive delta, or moving up. I need some positive delta. Then how much do I need? So if I want 20, it's going to try and find the closest call that's 20 plus half the fudge factor, or half of this plus the fudge factor. So 10 plus 2. So it's going to try and find the call with a 12 delta or less, and the put with a 12 delta or less absolute value. So these are the closest ones they found. So the total is 18. And then because you've got the hedge combo, you've also got this other put, and that's subtracting 1 delta. So here's the total delta for these, the total delta for these, and then the combined delta. So if you say, well, I want 20, maybe I'll go for like, let me try 25 on the delta finder. And we're getting later in the day, so there's not as many strikes to choose from. So it's having a hard time finding some. So here's one that's, this hedge combo would be plus 24 delta. And now if I click on this, there's the order to paste into Thinkorswim, and it tells you this is a single order, and it's already in the clipboard. So you can literally just go over to Thinkorswim, the order entry, hit paste and analyze. And I got to delete all these other trades. There's your risk reversal. So if you wanted to take a little shot on the market ending higher today, you could certainly do that. And you know, if it, as long as it closes above here, you won't lose anything. You'll actually, well, you'll lose whatever you paid. I think it's a 40-cent debit right now. But that's how you, and then here's their 23 delta that you're looking for. So that's a nice way to help control positions if you're managing by the Greeks. So it's very powerful because you have all these different options or alternatives for how you want to hedge. You know, do you want just a synthetic long or short underlying? You want a hedged one? Do you want a risk reversal, a debit or credit spread, or a single? So it's a great tool. I love it. Okay, so that's the GOAT. So let's talk about the workshop a minute. So there's a new workshop that we're starting next week. It's on butterflies and condors. Probably get the idea, right? So you're going to get, it's kind of like the 0 DTE workshop we did in March, which was great. I had a lot of fun with that. You'll get tons of ideas and tips for trading both strategies. And as you saw, the GOAT spreadsheet really enhances and speeds up your Thinkorswim order entry, especially things like when you make an adjustment. You know, I can't imagine anymore just looking at a Thinkorswim option chain, trying to think, okay, how am I going to build a risk reversal that has the delta that I want, you know, versus just hitting the button on the delta fixer. So it just speeds it up so much. And then as far as the workshop goes, we've got 9 people that are going to be teaching different topics. And some of them are here: Amy, Wayne, Dan, myself, and then we've got some others. John Einar, he's in Norway. He does the break-even iron condor. Scott Ruble was a former floor trader in the CBOE. He was the head educator at Optionetics at one point. He started random walk trading and then later stratagem trading. But he's a wealth of information, really good trader, and he's funny, really good friend. Ricardo, I've known Ricardo for a long time. He's runs optionelements.es in Madrid. He's originally from England, so his mother language is English, but he's also very fluent in Spanish, of course. But he's going to be teaching a bearish butterfly. And Amy here, I know you said you're going to do one, we know, on the long-term or longer-term condors. And Amy's still thinking about the second topic, but it'll be probably something related. And then Tammy Chambless has the multiple entry iron condor. She's going to be giving an updated version of that. And Wayne, who's also here, has environmental trading and really great products over there. The calendars are working pretty well, Wayne. And Wayne's going to be doing an introduction to butterflies, and then another topic about, well, you see it on the next slide, about if something's good or bad for the trade. And then Bruno, another good friend of mine, he's he used to run the Rhino Trade Alert service with me, and then he got a job offer with a family office in Barcelona, and now he's trading just the Rhino trade in size. So he's doing probably 6-7 figure trades on the Rhino. So it'll be really interesting to see how he trades it. And I know he's got really tight risk tolerances for how much drawdown he can have. So it'll be really interesting to see Bruno's current Rhino variations. And then these are some of the topics we're going to talk about. This is like pointer. Oh, there it is. Okay, so that's Wayne, and this is the other one for Wayne: how to quantify a good and bad environment. And then we've got Amy, and then this one probably going to change. Now we're not sure yet, but that'll be soon. We'll know. Then Dan and I will be doing this, and then John Einar will be doing the break-even iron condor. We'll be doing some live trading with the Narrow, and then that's Tammy Chambless. These two are Scott. The Newton's Cradle is interesting, and like Scott mentioned the other day, it's probably something not a lot of people have heard about, but it's basically like adjusting. It's part of adjusting other trades or trying to fix other trades if they're starting to get in trouble. And then this is Ricardo. They're doing a bearish butterfly. I'm not sure how it compares to something like a John Locke bearish butterfly, but he's been doing that for a few years with his folks. And then Wayne's going to be doing this, so it sounds like a good one. Bruno's Rhino, and then I'll do a spreadsheet walkthrough. So lots of good stuff. And then we're also going to give 6 weeks access to the 0DT trade alerts. And then Scott's giving 1 month access to the Stratagem Practical Option Tactics, or POT class. And Wayne, you're going to give access to the Environmental Edge Adapt Daily Options. And maybe, Wayne, can you talk about that a little bit? Just what exactly is that?
Yeah. So in general, I am pretty much kind of like the environmental guy, right? I like to set up trades based on various factors in the market and variables that I can measure and quantify. So to kind of simplify that down, what I end up doing as a service is taking all these metrics and all of this data, and then we push it through. I know it's a buzzword right now, but like a machine learning algorithm or AI, but basically it pulls it down and it says, okay, what are the optimal edges to push on, and what types of structures will benefit from this current environment. And then that is turned into basically a simple trade that is executable. And then from there, we have an allocation model that's derived from that, basically saying, okay, this is a good trade, but how much can we actually risk? And that way we can keep the account growing in a steady basis. And so all of that is part of that service. And yeah, we're up, just over 30% for the year. It's a little bit more laissez-faire, where you just enter once a day. You don't really pay attention to it, but for your little trading window. So typically it takes me about 20 minutes a day to manage it. And then you kind of move on with your life, and everything's really nice. So
Nice. And I know, Amy, you mentioned you're going to be doing some Russell Iron Condors. Did you want to talk a little bit about what you have in mind?
Yeah, sure. Since we're talking a little bit more about longer term structures here, I thought I would talk a lot about some of the longer term iron condors that I've done in the past and they're still, great trades that have lasted throughout the years. And I decided to, most of the trading I did in those was in the Russell 2000, which I think is going to be great, because most of what we've been trading lately has been the SPX. So I thought this would be a good way to diversify, not just because it's longer term, but also the RUT moves differently. It's, than the SPX. It's not controlled by, the 7 top mega tech stocks like Apple and Google and Amazon. I mean, they're, there's about 7 or 8 stocks that are really moving, the SPX around. I think they're covering about 27% of the SPX. So they're, kind of outsized as far as if they do well, then the SPX does well, but those are not in the Russell 2000. So it kind of gives a little bit more diversification that way. So I thought that would help with that as well. And then just different ways of adjusting styles of these longer term structures that we have kind of gotten away from with all the shorter term stuff. So I thought it would be, you know, a good lesson in that. A little bit less action, but definitely really good trades to have in the portfolio, or good strategies to have in the portfolio.
And as far as like diversifying, I know I had built a long time ago a trade simulator, and I can probably just give you a demo of that real quick. So where's my trade simulator? Here it is. So if you go to trade simulator, it's under tools, trade simulator. If you just pick a system and you set up the parameters for it, it can have really jagged results. And this little moving average, by the way, is a technique from Joe Ross, or you put an EMA on your equity chart, and as long as the equity is above that moving average, then you're still trading it live. So this would be, haven't crossed it. So if it did cross, you would go to paper until it crossed again, then we go back to live. And that's why I put it there. But if you generate these, you can see, like, here's a good example. This compared to the last one was very, very different. If you were in this trade, you made some money, and then it went down for quite a while and then started making money again. But you had this whole period here. If you were following Joe's advice, you'd be in paper, and then here you go back to live. But it can see it varies quite a bit, right? So it's all random. Here's another one that's pretty good. But what if you did let's say 20 trials of 120 trades? So this will create like a basket. And what tends to happen, if you look at these, you'll have, this was the best one of the 20, and this was the worst one of the 20. But what you'll see if you have a basket of trades like this is that your equity growth, if it's positive expectancy, will just slowly climb like this. And I think that's the kind of stuff that Wayne's talking about, where you're allocating stuff over multiple things and you're trying to get this black line to increase at a nice rate. And you notice there's not many, a little bit of a drawdown, but not much. But that's the benefit of having multiple trading systems working together, because one might be doing well and one might not. Like, I think Charles Cottle used to say, have 10 strategies, 1 neutral, or 3 neutral, 3 leaning short, 3 leaning long, and a lottery ticket. So a spec trade. But that's a really great thing about diversifying with multiple assets. That equity curve can be much smoother. And then also in the workshop, you can get access to the spreadsheet that we use. I've already set up a private forum. I'll set up a Discord channel. I was surprised how many people wanted Discord with the A14. So I just set that up last week or this weekend, and there's already 50 people using it. So if you bought the A14 and you want to get in, go to the Discord channel button on the A14 page, and you'll be able to get in. And if you need access, let me know. And then, of course, with everything, it's all recorded and with indefinite access. So I do have a link for this. So airmere.com/2023 BC workshop, like butterfly condor workshop. And I can probably get the URL for that and paste it in the chat. Let's see, where's my PowerPoint? It's not. Well, I gotta just type it in. Yeah, there it is. Okay, I'll paste that in for everyone. Okay, so if you go to that page, I guess we can just do that now. It talks a lot about the different strategies that we're using. I got to edit this a little bit because that's changed already. But you'll see the stuff we just talked about in a little bit more details, like John Einar's yield of 70% in 16 months kind of thing. And then here's the schedule. So if it's green, it's confirmed, red is unconfirmed. So I still have to, the date and time are confirmed with Amy. We just got to get the topic. And then Bruno is going to be in the first week of August at this time, but we don't know the exact day yet. So we have a good schedule set up. We're going to start Monday with a kickoff meeting, and then Dan and I will be doing a class on the Narrow Iron Condor with the latest iterations. And then John Einar will be doing the break-even Condor, and then I'll be doing a spreadsheet walkthrough, and then Dan and I will do a live trading session on Friday the 14th. So, and then Scott's doing the short butterfly, Ricardo, blah, blah, blah. So you can see the whole schedule here, but it's pretty full July, but I tried to space it out, every couple days. So it's not like the fire hose effect, we used to call it in the Air Force when you get a new airplane system, you got all this stuff to learn. It said open up wide and try and get as much as you can in. But I tried to space out a little bit so the learning, it's not more spaced out a little bit, so you have time to absorb things and ask good questions. So anyway, there's just a link to order it if you're interested. It should be a lot of fun. Like the last one we had, the 0DTE. There's like you said, Dan, there's like a smorgasbord of different strategies and ideas here. So like Scott's short butterfly session will probably be something that most of you guys haven't traded at all, or the Newton's cradle, some new things that you've probably never seen, and really good to add to your toolbox for trading.
Oh, yeah, I haven't seen that Newton's cradle. I have no idea what that is. That's completely new to me. I thought over 30 years I had traded everything, but not that. I don't know what that is.
Well, the Newton's cradle, like Scott said, it's a way to clean up risk and hedge other positions. So it's
all right. That'll be interesting.
Yeah, it's a good one. So again, it's a lot of good stuff in here, some good value for the stuff that everybody's giving away, and should be a lot of fun. We had a lot of people sign up last time, and I lowered the price a little bit to help people make it more affordable. But if you guys are interested, it's going to be fun, I'm sure, and you should learn a lot. So anyway, let's I think that's it. We need to wrap it up because I gotta get heading out to the base for Gabby's appointment with the surgeon. So
yeah, I hope that goes well, Tom.
Yeah, thanks. And thanks, Wayne, for joining, and Dan, really appreciate it. And I look forward to the workshop. It should be a lot of fun. So thanks everyone for coming, and yeah, I'll end the meeting and we'll see you soon.
Thanks, Tom.
Great.